Chairman, thank you. Chairman, thank you. At least one member of the Open Market Committee has said that combining a relatively steep path of rate increases with a relatively modest reduction in the balance sheet could flatten the yield curve and distort incentives for private sector intermediation, especially for community banks. Help me understand the relationship between balance sheet decisions and rate increase decisions, and what thought process you would undertake in that regard.
So we basically think of the interest rate as the active tool of monetary policy, and we think of the balance sheet as something we do really in urgent situations. We buy assets, and that tends to drive down long-term rates. So what we're very much about to do, and we're going to do this over the course of this year, is both raise interest rates, and we're going to begin to allow the balance sheet to shrink and run off. As the balance sheet shrinks, it really depends on what, the securities are maturing is what's happening, and Treasury, on the other side of the wall, Treasury's deciding what to issue. So they issue long, short, in the middle, that's what they do. So, but basically, and that will have an effect on the yield curve and on financial conditions, but those are decisions that Treasury makes. But the way we do it, though, to answer your question, is we want to decide a path for the balance sheet, and then we want to let it go in the background and have the interest rate tool meeting to meeting be the active policy tool. I hope that's responsive.
And what's the different consequence between altering the balance sheet and altering interest rates?
For the shape of the yield curve,
yeah,
you mean?
What happens differently in the economy as a result of doing one or the other, or is there a reason what's the reason to do them together?
Well, we use the tools when we're using them actively, cutting interest rates and buying assets, buying longer-term assets. We're trying to provide support for the economy. The interest rates affect shorter-term rates. They actually, more than they affect longer-term rates. Quantitative easing affects longer-term rates, and those are important in the economy. When you turn it around, really, as I tried to explain, we shrink the size of the balance sheet, but really, for example, if Treasury were to issue only long bonds, well, that would drive up rates, and that would tend to tilt the yield curve up. But that's a question for Treasury, the issuance question.
And I'm trying to understand why you're trying to explain, and the fault probably lies with me, but is there in regard to interest rates, long-term, short-term, does it matter which of those tools you use? And is there a consequence different to an American industry, a sector of our economy as a result of the machinations between those two tools?
Not really. Again, our interest rate is an overnight interest rate, right? And so when we change it, it will affect asset prices all the way out the curve. It'll affect equity prices and things like that. But ultimately, if you're at the zero lower bound and you can't cut anymore, then you're in one sense you could be out of tools. And so actually Milton Friedman was one of the first to talk about this many years ago with respect to Japan. You can always affect longer term interest rates by buying sovereign debt and so that tends to bring down longer term rates. They all matter for the economy to the extent you borrow long. If you're someone who likes to borrow very long, like investment grade companies, then your rates will go down for 30-year lending. Most people, the short end is more important.
Mr. Chairman, I'm not going to ask you about energy policy, but let me ask what percentage or what's the quantification of how inflation is related to energy prices?
So energy inflation is when we talk about core inflation. We exclude inflation from energy and food prices because those are quite volatile. So right now, I guess if you look at the way we look at it, core PCE is about 5, in the range of 5, and energy inflation and food inflation, you put it on top of that, is in the high 6s. So it's close to a couple of percent, I believe.
And just in my last 14 seconds, highlight, I always worry about farmers and ranchers, small towns, community banks, lenders to those farmers and ranchers. interest rates and energy prices combined have a huge consequence to those who feed and clothe and provide energy to us and the world. And decisions that you make have perhaps an exacerbated consequence to somebody who borrows significant amounts of money to put seed in the ground at a time in which fertilizer costs, diesel fuel is extremely high. Every input a farmer faces today is here. While commodity prices have risen, they've not risen sufficiently to overcome the cost of production.
So we're very much aware of that. Some of this shock is going to be very tough for agricultural companies, and that's something we'll be monitoring. We don't have the tools to deal with that very well, but that's clearly a risk.
Mr. Chairman, thank you.
Thank you.